Hi, my name is Ray, and welcome back to another episode of Ray's Economics Cluebook. Today, we're talking about another way of measuring GDP or economic performance. We go on our third section of this topic. Now, previously, we talked about the two other ways to measure GDP. We talked about the expenditures approach, which is basically consumer spending plus investments plus government spending plus net exports. We talked about the income approach, using the logic that total inflow equals total outflow. And both of these were from a buyer's income perspective. However, lastly, we're going to talk about it from a seller's perspective, the production approach and value-added approach. Now remember that GDP is basically all about this graph, or this picture right here, the circular flow model that shows the economic interactions between all the different entities in an economy. Now basically measuring GDP is all about just looking at this circular flow model from different perspectives, from a buyer's perspective, from an income perspective, and in today's video, from a seller's perspective. Now, what is value added? Well, first of all, value added is looking at the different approaches or different steps in the production chain. And we're only looking at the final goods and services that are in the steps of the production chain. Now, let's say we're looking at the production of orange juice. Now, the different steps of orange juice, of course, are growing oranges, making orange juice, distributing the juice to the retail stores, and then having the retail stores sell to the consumer. Now, in these different steps, there's going to be different value added. There's going to be a difference between the price of the product in the step sold versus the cost of producing the product. Now, and in the difference is basically our value added, or maybe perhaps our profit. Now, for instance, when we look at our growing oranges, we basically have, in this theoretically speaking, we have no costs, but we sell it for $1, and we have $1 value added. Now, when we're making the orange juice, we basically have another 50 cents of profit, perhaps, or value added. So we have another 50 cents of value added. Now, distributing the juice to stores, now there's a difference of 75 cents between the cost and the price of selling the juice to the stores. So we have another 75 cents of value added. And finally, the retail stores add on a difference of $1.25 when selling to the consumers. So we have a final value added of adding all the different value added values from the different steps. And finally, we have our value added of $3.50. So from this selling juice to a consumer, our overall GDP from this is $3.50. Now, it's worth mentioning that $3.50 is the same as the price of selling the final juice to consumer. And when we're looking at the expenditures model, we can see that basically this counts as consumer spending. And consumer spending in this case also $350, which is the same as our value added. So this really shows how our two steps, our two approaches, really go into each other and are the same in that respect. And of course, there are different things to consider, of course. For instance, GDP is only is domestic. It's only within your country's borders. So for instance, what if the orange was grown outside the US? What if the orange was, say, grown in Mexico? So in that case, well, the value added of growing that orange of $1 is a GDP of Mexico only, because it was grown in Mexico. It's domestically produced. However, the rest of these steps, the value added from the rest of these steps counts toward the GDP of the US, if they happen in the US. So basically, we need to remember that we look at everything that's domestically produced and only look at the value added values that are domestically produced. Secondly, we also have to mention that GDP is usually counted toward a specific year, a specific timeline. So we only look at the value added within a calendar year. So for instance, if the orange was grown in 2017, but the making of the orange juice was done in 2018, then the 2017 GDP will only include the value added of growing that orange, because that was the only step that happened in 2017. However, 2018 GDP will not include it, but will include the rest of the orange juice making, because those steps occurred in 2018 and only count towards 2018's GDP value. So finally, it's worth mentioning that the VIP in learning, the most important part of learning, is the big picture. Now, we look at the big picture, we can finally see how all three approaches are basically the same in the value of GDP, because they're all looking at this picture from different perspectives. And one last thing to mention about value added that's very interesting is that many countries, especially developed countries, use a value added tax that basically is derived from different steps in the production process, or the value added. Now, the US does not have this, but many people believe that the value added could be a powerful tool in helping solve the U.S.'s fiscal issues, because as we all know, Scandinavia, for such as Norway, uses the value-added tax to keep itself relatively fiscally healthy. So the value-added tax is really a powerful tool for tax revenue collection. So that being said, thank you for watching our video today, and we'll see you next time. Bye bye.